Hey everyone, and welcome to Mortgage Minute Live, where we map out and navigate the road ahead with current housing market insights, trends, and new product updates. Today, we're here with Benchmark COO and TMBA President, Steve Remington.
Hey, Megan.
Hey, we're back. Well, let's get right into it and navigate our first road sign in the current market. Awesome. Topic one today is Fed speak and next moves. About a week and a half ago, we had the Jackson Hole Summit, and we've had a lot of commentary over the last week and a half. So get us up to speed.
So that afternoon, the end of the week, Fed Chair Powell came out and gave his press conference. The market didn't really like it. It was hawkish, meaning you know they're going to keep their foot on the accelerator for rates going up. So, or at least that's the bias. So, but then following that, you've got a lot of Fed presidents speaking last week, all throughout the rest of this week. And then Chair Powell speaks again on Friday. So there's a lot of chatter out there right now, and everybody's going to be hanging on every word, trying to read between the lines. So between that and then next week you have on September 13th the CPI Consumer Price Index, and then on the 14th the Producer Price Index, your wholesale inflation. So we have one more week of kind of inflation data that the Fed will chew on before their next meeting on September 20th and 21st. So Wednesday the 21st, they'll announce how much, if any, they're going to increase the Fed funds rate again.
Okay, perfect. And moving into topic two, Steve's going to go over current market and interest rate behavior.
So the markets have baked in or priced in somewhere between 50 and 75 basis points. That's the range that they've indicated or hinted at for the next rate increase. If you look at the statistics, the futures market is saying, okay, it's 0.70, 70 basis points. So obviously they're going to do half or three quarters. I mean, they could do a quarter, they could do nothing. So, but the market is essentially gambling on them making that move. It's priced it in. If you go look at other indicators, the 10-year Treasury has actually bounced off a 3.35%. It's come back a little bit at 3.29. So, but if you look at this graph over the last couple of months, it's been a steady climb in the 10-year Treasury yield. Switching over to now, how does that translate to mortgage rates? The conventional 30-year fixed average rate this last couple of days is about 6.14%. And this is using some ICE, Ellie Mae, and Compass data for the aggregate industry. So, but if you look at where we are relative to the 100-day moving average, which was at 5.76%, that's a pretty good little jump that we've seen here in the last couple of weeks. And then translating that for the originators out there from a mortgage-backed security, pricing has dropped here in the last several days below the 30-day moving average. But the good news is we're not at the lows we saw on June 15th.
Awesome. For those of you just tuning in, let's recap with Steve's keys. So give us, Steve, the key points from today. Key one being brace ourselves.
Brace yourself. So
buckle up.
It's not the end of the world, but you need to brace for some short-term volatility. So the market is taking this perspective of, okay, we're assuming the kind of worst-case scenario, the Fed's going to be very hawkish and raise 75 basis points. So the market's priced that in. If for some reason the CPI number comes in a little cooler, or the speak is a little bit more dovish, less hawkish, then the market might rally back a little bit, and you'll see this, a little bit of improvement. So really, just brace for volatility. It's not the end of the world.
We'll wait and see. And then for key two of today, Steve's just looking more at that Fed speak that you were talking about on Friday, and then the CPI, PPI data that's going to be released next week.
Yeah, the Fed speak is going to be kind of hints and reading between the lines. The data is going to tell you a better story. So if you remember the last CPI, PPI report, we kind of saw planing out for the first time. Inflation was not climbing at the same rate. It showed a sign of maybe cooling. So if we get another month of cooling, maybe a little down, then that would be that sigh of relief, and maybe the Fed doesn't have to be as aggressive. So just watch real close next week, and then that gives us a full week before the next Fed meeting. So you might see some volatility, but just read the data. You can access that on any public news network, CNBC, Fox Business, or just search it on the internet.
Awesome. Well, that's all the time we have for today. Thank you so much, Steve, for coming onto the show, letting us know what you know.